As someone who is looking to invest in the stock market or who's already investing in the stock market, one thing that is super powerful for you to use in order to make some great investment decisions is to be able to value companies effectively. And the reason why is because if you're able to value companies well, you're essentially able to buy companies for a lower price than they're worth. After that, of course, you can sell them at a higher price and make a profit. Now, of course, there are many different strategies and methods of valuing companies, and in this video we're gonna focus specifically on the relative valuation. The best part about this valuation method is that it allows you to compare a whole bunch of companies across any key metrics that you desire and realize for yourself whether or not a particular company is undervalued or overvalued. Okay, so as you can see, I have set up this spreadsheet, and the really cool thing is that at the end of the video you're gonna be able to do exactly this. So only select the company tickers that you're looking to analyze with the relative valuation, select the parameters that you want to evaluate those companies across, and then click right here, click on get data, and that will automatically populate the data that you want right here on your spreadsheet. And then you're going to even be able to assign ratings to those companies, so that way you can quickly identify whether, according to the valuation that you picked, a particular company is undervalued or overvalued. Okay, so let me explain to you how this works and what are the best practices for relative valuation. So first things first, this works across pretty much any public company that you want, as long as it's listed on a major stock exchange and that you use the Yahoo Finance ticker system. This list could be pretty much as extensive as you want. This method supports up to 1,000 tickers at a time, so the length of your list won't be a problem. The one thing that you do need to do if you want this to be effective is to look at companies that are in a similar industry, similar sector, similar size, because otherwise your relative valuation is not going to be accurate. If you compare a construction company with an oil company, the metrics are not going to line up because the two companies are very, very different from each other. Now, with that being said, after you pick that list, this is something that you can easily Google and type in, for example, in this case, semiconductor stock list on Google. You copy paste that into your spreadsheet, you have this part done right here. Now, the other part is to pick the metrics that most matter to you. There are many different videos on YouTube as well as articles online that you can check out on the different relative valuation metrics. So in this case, I just have some of the most important ones, so the P ratio, price to sales, price to operating cash flow ratio, etc. You can see the rest of them here. And for this model and in this example to work correctly, you need to pick one metric that you want to analyze companies across. So you can always change this metric. In this case, the one that I'm using is the price to sales ratio, and I'm gonna explain to you how that works. Okay, before I get into the implied value and the rating, how that works, I just want to share with you where it is that you can find the metrics that you can evaluate and compare companies across. So if you go on this page right here, wisesheets.io/available data, you will see screener data. You can click here and you can see all of the data that's available. This covers key metrics, which are the ones that we're looking at right now. So you can see like P ratio, price to sales, etc. You can obviously compare against other stuff in the income statement, the balance sheet, the cash flow statement, and there's a whole bunch of other stuff that I recommend that you can check out. Of course, you can just search for the particular parameter that you're looking for, and you can see how it appears right here. So if you click here, you can copy paste it into your spreadsheet. Now onto the parameters themselves. What do you need to do? Well, first you see if you get rid of all this data, you need to get it. So if we select the list of tickers like I did before, select the list of parameters, click right here, and then click on get data, you will see how automatically everything will populate for you, which is really, really powerful. And you can see this is like super fast as well. We're not speeding the video or anything. This is the real speed of the data retrieval. Now, what P ratio, what price to sales ratio, what metrics are being pulled? That is the key question. So the P ratio that is being pulled, for example, is based on the latest fiscal year of the company financial results. So the P ratio that you see right here is based on the price that the stock was trading at the time the financial statements were released, as well as the earnings of the company at that particular time as well. The same applies for the price to sales ratio and pretty much any other ratio that you can see right here, except of course the market cap and the price, which are live metrics. The revenue at the same time comes from the latest year of data available. And the best part about this is that you can also change this to your own liking. So for example, let's say that you want to take the P ratio right now on a TTM basis based on the latest earnings of the company and the latest stock price. If you just add TTM to this and then click on get data, you can see how this automatically updated, and now you have a whole set of different values to work with. You can also do LY, which is the latest year. That is the default. You could do LY -1, which is the previous fiscal year. You could do LQ, which is the latest quarter, LQ -1, which is the quarter after that. And for that, you could do up to LQ -9 and LY -9. Now, onto the analysis itself, you can see right here, I'm taking the average and the median. And for this, I'm just using the simple Excel formulas. So in this case, the average formula, and here you will see the median formula. Once you do this, you can simply drag this across, so that way you can have this calculation for all of the different metrics. And then, like I said before, you need to pick one metric that you want to use to value these companies. And this is something that you can change, and you can have them all in different columns. In this case, the one that I picked is the price to sales ratio. So to calculate the implied value of a particular stock using the price to sales ratio, it's very, very simple. You take the company's revenue, and again, this could be TTM, this could be LY, it really depends on your analysis, and you multiply it by the ratio that you want to use. So in this case, I took the average, but you can also change it to be the median, and obviously you're gonna get a different number. Usually, the median is a really good measure. However, it really depends on the data. In this case, I would use the median itself because it seems to be like a more balanced number, more conservative number. And you can see that what it's doing is taking the revenue of the company, multiplying by the median of all of these companies right here, which it makes sense to do because they're all semiconductor companies. And this gives you what the real value of the company is, just on this metric. This is not a DCF, this is nothing like that. This is a relative valuation. This is just compared to what the other companies are doing, taking the median and then calculating the value. And then for the rating, what I'm doing is just a simple calculation. So I have an if formula, and I basically say if the implied value is higher than the current market capitalization, then the company is undervalued. And if the opposite applies, then it's overvalued. And here what I did is I used some conditional formatting, which you can click right here to do, highlight and then equal to. And you can see you can set up a rule here where you can say equal to overvalue would be red, undervalue would be green, and that's how this is performed, so that way you can quickly identify these companies. The last thing that it's important to mention is that you can also apply any filters that you want to this data right here. So for example, if I go ahead, apply a filter, and I say, you know what, I want to sort by the companies that have the highest price to sales ratio or the lowest P ratio, I can also do that. You can see how everything changes. And then if I want to do an update to the data, which you often want to do, you can just click right here and everything will automatically update for you. So that way you always have the latest information for your analysis. One last thing, of course, is that you see that I'm using this Wisesheets thing right here. This is an add-on that works for Excel and Google Sheets, and what it does is it allows you to get the data automatically for all these companies. However, this same method works if you just go ahead and copy paste the data from multiple sources that you can find online into your spreadsheet. You can apply the same things. Obviously, it is a little bit more convenient if you can get it all automatically and you know that the data comes from a reputable source, but it is up to you at the end of the day how you want to do this. Now you know how to perform relative valuation in a way that's easy, automated, and also in a way that's really powerful and really will allow you to find better stock investment opportunities faster. If you've enjoyed this video, make sure to subscribe and turn on the notifications on so that way you get notified every time we release a new video like this that's gonna allow you to take your investing game to the next level.